Okay.
Well done.
Well, get rid of it.
Welcome to the last panel of the day. Thanks for being with us. Well, listening to a very interesting and relevant topic that we are pleased to talk about with you. And it's called Seed to Exit, and how to scale startups with an exit in mind. And this topic is actually equally important for investors that usually want to have an exit at some point in time, as well as most of the founders. And we will focus today on the exit via acquisition. As you know, there are different types of exits that are possible, but the most common one, not only in Europe, but also in the US, is the exit via acquisition, meaning the startup gets acquired by a bigger company usually. But before we start diving deeper into the topic, I would like to do a round of introductions. And why don't we start with David? And please tell us your name, your role, and also your approach to investment and exits.
Yes, perfect. Thank you, Anna. So my name is David Franzen. I am a serial entrepreneur, and I'm now the venture partner at the investment group Max Ventures, which is based out of Mallorca. My approach to investments is we focus on very early stage, so we focus on pre-seed and seed. But I think, as we'll get into now as well, it's of course very important to, even from the beginning, to start thinking about potential exit. Yeah, I think there's going to be a lot of things that we'll get into, but you need to keep it simple and not overcomplicate things. Have that in mind already from the beginning.
Great. Joshua, would you like to go next?
Okay, I'm Joshua Novick. I work for a company called Bondo Advisor. We're basically an M&A advisory firm, and we help basically tech companies in their exits. We work in the mid-market, so we're mainly doing deals, I would say, from kind of, lower end, 7, 8, 10 million, higher end around 50 million. These are the kind of deals we typically work on. And basically anyone which is in tech or digital, that's kind of our specialty. We work, most of the deals we do are between companies, so we haven't done a lot of deals with private equity funds. It's mainly a company selling to another strategic acquirer. That's kind of been our focus.
Well, Tom.
I'm Tom Horsey. I'm managing partner of Eoniq Fund. We're an early stage fund focused on Spanish-based founders, so the company can be anywhere, but we like the founders to be in Spain so that there's more opportunity for us to meet up with them and support them in any way we can. That's an important part of our thesis, that we only invest in startups where we feel that we actually can support them over and above money. And in terms of the rest of the thesis, basically it's 100K first tickets with the capacity with our new fund to go up to 1.5 to 2 million euros per investment.
Great. And last but not least, I'm Anna Fedulow. I'm the founder and syndicate lead of Croton Capital. We are a business angel syndicate with investors from about 10 countries, very diverse in terms of industry and functional expertise, backgrounds, networks, and so forth. So we are acting as a multiplied business angel, as I like to call it. And there are also some important aspects in our investment strategy. So we invest in tech startups from pre-seed to pre-series A with underrepresented founders and impact. So basically that's our focus. And geographically we invest in Europe and also beyond. And regarding exits, because that's the topic, so we aim for an exit ideally in a time frame of 5 to 6 years. And then obviously, because it's a, let's say, shorter term time frame, M&A is a good path that we're looking for, that we are evaluating, but it could be also in our case secondary, so that's our strategy. As mentioned, the topic is how to build a startup with an exit in mind. If you look at startups, what do you think is important for founders that actually want to go this path of an exit? What do they have to keep in mind at the seed stage? Tom, maybe you would like to start?
So I've got an interesting life experience anecdote here. So I've set up to date as a founder 15 different companies. Well, I lie. I've sold one of them, half. It's all signed, but they've only paid me 53%. And I remember being at an event in Malaga one time, and I was sitting next to this guy who'd been up on stage, and he talked about he'd set up 5 different companies, he'd sold 5 different companies. And I grabbed hold of him, and I said, at this stage, I hadn't sold any. And I sat down, I grabbed hold of him, and I said, look, well, how have you done this? You know, I haven't been able to sell any. And he goes, but I've never set up a company that's lasted 20 years. So I think the focus there is that he was focused on selling from day one. His strategy was to sell. My strategy as a founder was to build the business. And it sounds stupid, but in my personal experience, it's quite difficult to do both things. You know, it's a slightly different strategy. Yes, it's true that the company that I've eventually sold has been on the multiple of EBITDA, so I've grown the business as well as possible, and eventually I've sold for a multiple of EBITDA. But even then, you know, there's a whole process you have to go through in terms of, you know, trying to find buyers and going through the whole due diligence process. I think 2 different buyers in that particular process fell through. I've had about 3 or 4 other purchases that have fallen through at the last minute. So I think that the number one thing that a founder can do to sell is have that as their objective in you know, not the front of their brain, because they've got to focus on building the business, but at the back of their brain from day one.
Yeah, I think that's a key aspect of it, and we are going to dive deeper into it. David, what do you think, what should a founder that wants to sell, I mean, not all founders want to sell, and don't all founders have to sell, but if a founder wants to sell and has this mindset, what should they do at an early stage? How should they kind of approach that, basically continuing on what Tom said? If you kind of have this decision and this long-term vision, how do you go about it?
Yeah, absolutely. I very much agree with what Tom said. I think something as well that I think a lot of founders should do, that I myself also didn't do enough of, is really research the industry of investments, right? I mean, understand the whole ecosystem from the investor's perspective. A lot of times in the early stages, of course, I mean, as a founder, you have so much to do. You need to build product, you need to build a team, you need to do marketing, you need to do sales. And it might feel like building an exit strategy at that stage is premature. And I know that also a lot of investors maybe can be put off by early stage founders already having an exit strategy. So I think there's a bit of a potentially also even a taboo for some investors to see an exit strategy so early on. But I think for me, the most important thing is just for founders to understand what game they're getting themselves into when they raise capital. Because, as investors, we need there to be an exit in order for us to get our money back in some way, shape, or form. So founders must understand the basics of what that means. And I think that that's maybe lacking a little bit.
Great. I think that leads to Joshua, who is working on the exit at the point in time when it comes to an exit. So Joshua, in your experience, if you look at the startups you've been working with, what would you advise a founder that is on an earlier stage? What should they do at the beginning to basically get successfully to the end?
Yeah, we were joking about it before when we were here at the door. I was saying, you know, what should a founder do? And I was like, perform. He should perform. You know, you grow the company and do what he's supposed to do, and then he'll find a buyer. And you know, and I think that, you know, it sounds, you know, it sounds simplistic, but obviously I think that's the main thing he's got to do. On the other hand, I think there are things, you know, to an extent, a lot of the companies, and we were joking about the exit, another thing about the exit strategy, it's like, most companies are being sold. I say most of the exit strategies are actually bankruptcies. It's not really
we're getting to that one.
It's not a very nice exit, but I mean, that's the case. But I mean, I think a lot of the companies, you know, some of the companies perform and there'll be a excited buyer for them. And I think a lot of the companies, there's some which go bankrupt, and there's some which just basically never become what they believe they were going to become. And I think it's important to prepare for that. I mean, obviously, that can be your objective. But if you want to sell a company which hasn't, let's say, fully performed, I think what's very important is building, and this, what you were talking about is really understanding the ecosystem of who the buyers are. So one of the things I always tell, people in the startups, they said, look at, Salesforce. You look at, I think about 80% of the companies they bought were either companies which they founded with a Salesforce fund, or they're companies which were basically working with their APIs and they were basically integrated into their system. And I think that's the case, when you want to sell a company, you want to make sure that, you basically have a relationship with who could be your buyer. So it means maybe a company doing the same thing as you're doing who's international. Hey, meet them, give them a call, exchange best practices, hey, be on their radar. And also you might learn something. They're in a different market. They might be willing to share things with you, so it could be useful. And the other thing is obviously anyone who's a partner. So it's building a strong network of partners, resellers, anyone who integrates with you. These are your potential buyers. So if you build that, then even if your company's not performing, maybe they'll buy you because there's a synergy with a product, with something else, which is not you're necessarily, you haven't grown the company to do 10 million ARR, or it's not doing 20 million as EBITDA, but you have something which is interesting and someone who knows you and understands what you're doing, and those are potential buyers for those companies which don't go all the way, to be these, high performance company, which you don't even have to go and sell. There's going to be someone who's going to knock on your door, and maybe it's going to be 2 or 3, and you'll basically retire on them.
Yeah.
There's an interesting point there that
it tends to be the case. I mean, I tend to
but
bring up interesting things.
There's an interesting point there in that most of the sales that happen are companies that already know you, right? Yeah. So there'll be clients or providers, and even you were talking about exits, secondary. Yeah. So as an investor, it will be secondary. So it's other investors already in the thing. And why? Because it's so much easier for them to trust in.
They have a foot in the door already.
Yeah, they've got a foot in the door.
Yeah.
So if you are, and this goes back to a little bit what I'm saying of where I think you've got to have it at the back of your brain that I want to sell, because if you do establish those commercial relationships with companies that could potentially become your buyer or put you in touch with your buyer, you're building your business at the same time as you're potentially opening a door to a sale. I think that's a really interesting. Yeah. Obviously, it's an interesting point because you did it, but you said it. But I think there is a.
Yeah, I agree. I agree to both of you, and I'd like to add from the investor perspective, as for us, basically the exit strategy and exit potential is an area that we always try to evaluate, and also David, what you said, like by researching the sector and potential exit paths and so forth. For us, it's quite important to see that the founders are knowledgeable about, the types of exits, and also, what could be a potential exit timeline and so forth, and so that we can lead this discussion. Of course, it not always happens that way, but if you see that the founders do know about it and are prepared, it's very helpful. And I think many investors and the institutional VCs, they also really like to see that founders are prepared and that they want to go that path versus other potential ways to build a company. So I think it's always very good to be ready, to be prepared. David,
I think there's another concept that came to mind here as a result of the conversation here, that it might even be an interesting strategy as an early stage startup to really define who your potential buyers are, obviously very early on, and approach them way before that you are an acquisition target, and say, our vision for the future is so and so. In 2, 3, 4, 5, 8 years, we hope to be here, and at that point, we hope to be an acquisition target for you. We are now raising a smaller, pre-seed amount, would you want to invest basically? Because then, like you said, they would already have their foot in the door, and I think that's definitely something to, as a startup, to maybe already try to flip it, right? Not just go from A to B, from B to C, but try to be like, okay, where is my Z, and then kind of reverse engineer it maybe from
the
from
only thing I'd say on that particular point is that I personally think that's not always the best idea in terms of the investment. In terms of identifying them and
Yep.
putting yourself on their radar, yes. In terms of the investment, personally, it hasn't worked in startups where I've invested in, and I think the reason it hasn't worked is because there's an intrinsic conflict between the potential acquirer and the startup, right? So the potential acquirer, they're doing that investment to
a good
buy
point.
as cheaply
As
as
cheap as
possible in the
possible.
future, and the founders want to sell as higher level they can, right? So that potential conflict causes a little bit of problem. Not one single time that I've seen it happen, and it's happened, I don't know, like 5 times in startups I've been involved in. Not one single time has it come out
Yep.
right. Touch wood that it might with the next, but to date it hasn't.
Joshua, I guess you've seen kind of this type of conflict of interest in your basically exit cases. What would you say, what should founders consider if they already have an exit in mind, have researched potential acquirers, and they may be talking to some of them? What are things that you would recommend to kind of keep in mind, maybe be cautious about, that things go the right way?
But are we talking about the conflict of interest or in general things?
Yeah, conflict, like particularly the case where you are already kind of building the relationship with potential acquirers. Maybe they're already customers of yours. Have you seen such situations and conflicts of interest? Because I've come across a few of them, so I agree that it's important to kind of be careful at least.
Yeah, I mean, I think it sometimes depends. I mean, I think there a lot of some of the corporations or big firms, they kind of have a venture arm, and these venture arms tend to be more professional in the sense that what happens, I think, is more risky when you have like a direct investment from a corporation, and they don't really understand the venture world, and then then there'll be more conflict of interest. But again, I think what's difficult sometimes is mixing investors. So I mean, there's already a potential conflict of interest. I mean, there's always one between the entrepreneur, the founder, and the investors. I mean, it's always the case. It's very difficult that they're fully aligned. So also, if you bring in different kind of investors, so everyone is a financial investor, they're VC. Okay, then there's the conflict that some came in at one valuation. Maybe there's preferred stock. There's a waterfall. There's all that stuff. But I mean, everyone knows the game. But if you're bringing different kind of investors in, and some of them are not financial and they're strategic, then it can be an issue. And it's basically something you have to you basically have to decide if it's worthwhile. And I think sometimes it's worthwhile because they you think they can bring something to the table, as far as helping you grow. And other times it's basically because you couldn't raise money from anyone else, and sometimes we like to think that startups can always choose. They can't always choose, and sometimes they just have to raise money from who's willing to give them money.
Yeah. But that's super dangerous, just to accept money from somebody just because you can't get money from anybody else. I mean, of course, there's always the balance of if you need the money to, but yeah, you should of course try to avoid a situation where you're in that position in the first place. But I think startups really need to keep that in mind, that every additional investor that you bring on board adds a layer of complexity to the equation if and when you get to the position where an acquisition might be possible. Because I think
or just the day-to-day running.
Yeah.
Some investors are more complicated than others.
Yeah, but you did mention in the back as well that that out of your exits that you facilitated, that only one of them has actually been VC backed, which I think is a very interesting insight.
Yeah, that's true. And it was a pain.
That one specifically, okay. Yeah.
Yeah, they're like love investors, and just getting them all to the notary to sign was quite a thing.
But then just that simplicity is key. If you want to be acquired, you need to have your books in order, you need to be simple, and the more complexity, it just makes it way more harder at that point,
I think that's an excellent point, because I want to deep dive on exit readiness. So we've discussed what founders need to do from the beginning in case they aim to have an exit, right, by acquisition, most probably. But I also would like to just very quickly hear from all of you, what is for you exit readiness? What do you think? When is a startup ready to exit? What is the one requirement you would like to mention here? Tom, what do you think?
Oof. I think perhaps the number one thing that a founder has to do is decide at what valuation they're prepared to sell. Because, and when you reach that valuation, I will sell. Because there's always this temptation to not now, no, it's going to be more in 6 months' time or whatever. I think you've got to have that, ingrained in your head. If somebody comes along and they offer me X amount, I'm gonna take it. If there was one thing, that would be the one. I've made that mistake myself. I thought, oh no, but they're only offering me 5 times a bidder, and we're growing, so that's only actually going to be 2 times a bidder, and 10 years later the company's bankrupt, and I got some dividends out, but I haven't sold, right?
Yep.
So
I think that's a very important and very difficult one. So founders, take note. David, what do you think? What would be your one thing for exit readiness that you would like to add?
Yeah, I think it comes back to my earlier point about founders really needing to understand the business of acquisitions, right? I mean, acquiring companies is when you want to be able to make a profit, a margin on this purchase, right? So you need to be aware of that. You need to be willing to sell it and give the buyer a good deal as well, because otherwise the deal is not going to happen. So you need to be willing, I guess, to compromise a little bit on what you think it's worth in order to get the exit. I mean, yes, you might get less than what you were hoping for, but what you were hoping for is not always necessarily realistic. And of course, at that point, hopefully you have a nice exit that allows you to move on to your next challenge or whatever. But I think to be realistic and not be too demanding, if you want to make it happen, you've got to be willing to compromise a bit, I think.
And can I just add in a little thing here, because I had this conversation with somebody last week, and we were talking about valuation, at what valuation they would sell, and they were going through this, and they were thinking, oh no, I want, and I said, but just think about it. If somebody offers you 5 times a bidder, what they're actually doing is they're giving you a present of 5 years of life. Because otherwise you're going to have to work for 5 years to generate that. How much is 5 years of your life worth? This is somebody that was, they're an older founder as well, so they were about my age. I'm obviously 30, but they were slightly older, sorry. So they were about my age. I was going, Jesus, that's a huge value in that. Forget the money. Don't forget the money. But, it's not just about the money. And he said, yeah, you're right. And I think he's going through with it. But yeah, you've got to think that in reality they're paying you years of your life. Right?
Yeah, very good point. Joshua, what do you think from your kind of M&A expertise and expert perspective? What's the one thing you would say, founders, you need this to be exit ready?
Well, I mean, in first place, we're kind of going back to one point. I mean, obviously, when you're, I would say there are two kind of, to simplify, there are two kind of processes when you sell a company. One is basically a buyer comes, knocks on your door, and then makes an offer, and then you got to decide if you sell it or you don't, And you generally don't control when that's happening. So I mean, at that point you have to figure out if it was a good deal or not, and you have the right price, etc. And then the other one is that you actually go out and find a buyer. And I think that's a different process. So because you really have to think if it's the right moment to sell. While in the first case, you kind of just have to decide, this thing has come up, what's the risk and opportunity of continuing and moving on. So when kind of going back to the second point, I think it has to do a lot. I think there are a lot of different reasons why you should sell, and one, as you said, could be personal. Just the fact, Tom and I, we have a common past. We worked in ad tech. I don't know when you sold your company. Did you finally sold?
I never sold.
You never sold.
That was one of the ones I had 3 offers and they all fell through at the last minute.
Okay, you never sold. But you were there for a bunch of years. I sold my company after 17 years, and I had received an offer 10 years earlier, which I refused, and I sold it at the same price 10 years later. So
I had one that I refused in 2007 and it went bankrupt.
Yeah. So kind of going back to that, I think one can be just personal. The fact that, hey, listen, when I sold my company, it's been 17 years, I just had enough of it. I just felt like selling. That could be one of the reasons. And the other reason is that you kind of look at the market. So sometimes maybe your company is, you think you can grow it more, but then the market is consolidating. That happens a lot. So you're like I'm the player in Spain in this space, and there's a German company which is consolidating the market. Basically, if he doesn't buy me, he's going to buy my competitor. I'm going to be the small fish. There's all these big fish buying. Okay, then will it be easy for me? It's going to be a buyer. So you have to consider kind of aspects, things which are kind of happening outside, and understanding if it's the right moment to sell. There's a consolidation. There's something going on. And I think the third thing is really the risk and opportunity. Is that, hey, listen, can I, I'm growing 50% a year. Can I continue doing that? Do I really believe it? Maybe it might be worth, if you're still enjoying it, it might be worth, going on or not. And obviously, then the fourth thing, which is your VC or your investors are putting pressure on you to sell. And as an entrepreneur, then it's dealing with it or not. Obviously, I feel you have a responsibility. You brought in investors, and they expect to exit. They probably gave you some visibility of when they expected to exit, and it's kind of your responsibility to do that at some point. Maybe you can wait an extra year and tell them why it makes sense, but you can't just be, kind of waiting forever and running it as if it wasn't a VC-backed company. So I don't know if that answers the question or.
Yeah, absolutely. I think we have a wonderful bouquet of important aspects for being exit ready. Time is out. I don't want to hold you longer from your dinner and drinks. And I would like to thank the audience that stayed with this last panel until the end. Thank you very much. And also my co-panelists. Thank you very much. And we can continue the discussion later. So thank you. And see you around.
Thank you.